Welcome to the deep dive. Today, we're digging into a question that's really top of mind for a lot of folks in the professional world. What does the future hold when technology, especially AI, starts to fundamentally change, well, an entire industry? Our mission today is to take this stack of insights we've gathered from different AI perspectives, actually, and pull out the most important bits of knowledge to give you a clearer picture. Yeah, and that sets things up nicely. We got this really interesting prompt from someone who's right in the thick of it, a branch manager and loan officer at a mid-sized national mortgage lender, the kind doing maybe 2 to 3 billion a year in loans, right? Operating on a P&L, managing their own finances. And they're asking, will I even have a job in 5 years? That's the big one. And also, can a company like ours this size survive long term? They even sketched out a future where AI just handles everything, analyzing qualifications, making recommendations, comparing offers automatically. So we put that exact scenario to several different AIs to see what they'd say.
And what's really fascinating here, I think, is that we're not just looking at one opinion. We're getting a synthesis, right? How multiple advanced AI models see the future of this really complex, very relationship-driven field. So we'll be looking at the big macro forces driving the changes. We'll explore the best case and worst case scenarios, both for individual roles like our listeners and for the companies themselves. And then crucially, what are the strategic moves being recommended? For survival, but also for growth. It really brings up the core question. How do we actually use these collective insights to get ready and maybe even, thrive in this landscape that's changing so fast?
Okay, great. So with that mission laid out, let's start big picture. All our AI sources seem to agree the mortgage industry is really on the edge of some massive transformation. Beyond just the AI itself, what are the fundamental forces pushing all this change?
Well, if you connect it to the bigger picture, it's really a combination of several powerful currents all hitting at once. AI and automation are obviously central. That's kind of the engine here. We're talking about much faster underwriting, automated document checks.
The tedious stuff.
Exactly. Borrower-facing AI for answering questions 24/7, even predictive analytics for market trends or personalized loan offers. Think about tools like intelligent document processing. They can autofill forms, flag potential fraud, stuff that cuts approval times from, weeks down to maybe just hours in some cases.
Hours. Wow.
Yeah, and looking even further out, some models imagined agentic AI. These are AI systems that can make decisions and act on their own, enabling things like instant pre-approvals or even each ELO sees right from an app. But it's not just tech. We've got significant regulatory shifts on the horizon, too. Expect new credit scoring models, like wider VantageScore adoption, perhaps. Streamlined appraisal rules are coming, plus really crucial data privacy requirements. And there's definitely a push for stricter rules around AI transparency and bias, making sure lending stays fair. You see bodies like the CFPB watching this very closely.
Right. The fairness aspect is huge.
Then there's consumer behavior. That's another massive driver. People just expect instant answers now, right? Mobile-first experiences, easy rate comparisons side by side.
Like shopping on Amazon, basically.
Precisely. And you've got tech-savvy millennials and Gen Z hitting their prime home buying years. They're driving these expectations hard. Market concentration and competition also vital. You've got the big players like Rocket, UWM. Yeah, with huge tech budgets pushing really hard for dominance. And there's this looming possibility of big tech, Amazon, Google, Apple partnering with top lenders. Imagine financing just bundled right into the home search. That could potentially cut out a lot of independent competition.
That's a scary thought for smaller players.
It is. And it's interesting. Often it's the non-bank lenders leading the AI innovation charge, partly because they might have, slightly lighter regulatory framework sometimes. And finally, you always have the underlying economic and housing factors. Interest rate cycles, they'll keep bringing volatility, though some AIs did predict things might stabilize, maybe around 5-6% by 2030. We'll see.
Still higher than recent memory, though.
Oh, absolutely. And housing supply is still tight structurally. That impacts how many deals actually happen. Plus, think about broader AI-driven unemployment. If that hits, say, 10% across sectors, like some models projected, that could increase mortgage delinquencies, maybe depress home prices. And just the nature of home ownership itself is shifting. More gig workers, more self-employed folks. Lenders have to adapt how they underwrite for that.
That's a really complex mix of forces. Was there any one of those, though, that the AI's flagged as having a surprisingly bigger impact than maybe we'd expect? Or one that poses a really unique challenge?
That's a great question. While they're all significant, the thing that really jumped out consistently across the different AI perspectives was the combination. The pressure from consumer behavior and market concentration.
Oh, okay. Those two together.
Yeah. The expectation for instant, digital, really transparent processes means if you're not agile with tech, you just won't be able to keep up with the big guys who are pouring billions into it.
Yeah.
So the challenge isn't just adopting AI, it's doing it fast enough and at a scale that meets these consumer demands that are changing incredibly quickly. Otherwise, you risk being totally outmaneuvered by the giants. It's that speed and scale combination.
Fascinating. Okay, let's zoom in now. The question that's probably front and center for our listener. Will I still have a job in 5 years? What did the collective AI brainpower reveal about the future of the human loan officer?
Well, the overwhelming consensus, really across all the analyses we looked at, is yes,
Okay.
you will have a job, but, and it's a big but,
Yeah.
the role is going to look quite different.
Different how? More rewarding. Less.
Potentially more rewarding, actually, if you adapt. What did the AI see as irreplaceable? Even with AI handling, say, 70–80% of routine tasks by 2030. Things like doc verification, initial underwriting, credit scores.
The grunt work, essentially.
Pretty much. They all agreed AI is great at the transactional stuff, but it struggles with the relational side. Your value shifts. It pivots away from just processing the loan to becoming a trusted advisor. That means interpreting things for clients, explaining the why behind their options. It means building and nurturing relationships with agents, with past clients, and handling those really complex scenarios, you know? The ones that need human empathy, judgment, creative problem solving.
Like the self-employed borrowers you mentioned or people with tricky credit.
Exactly. Or navigating alternative lending options. Stuff AI just isn't equipped for. Not really. So the predicted reality is what some sources called the Centaur model.
Centaur, like half human, half AI.
Sort of. Humans working seamlessly with AI, that's the idea. Loan officers spend way less time on paperwork, much more on strategy, on personalized service. The AI tools boost efficiency dramatically. Some models suggested maybe funding 3 times as many loans per officer.
Wow.
And seeing productivity gains maybe up to $2,000 per loan. That's significant. Your job becomes overseeing the AI's output, making sure it's accurate but also fair, especially with regulators watching automated decisions so closely.
So you're like the quality control and the human interface for the AI, the Centaur model. It sounds powerful, that synergy. But did the AIs flag any potential friction points or maybe unexpected challenges in making that human-AI integration work smoothly?
Oh, absolutely. 2 big ones that came up repeatedly were change management and skill gaps.
Ah, the human side again.
Exactly. The AIs pointed out that making this Centaur thing work isn't just about having the tech, it's about loan officers being willing to adapt, you know,
Yeah.
to actually trust the AI and, crucially, to upskill into these new advisory roles. If firms don't invest in training, in changing the culture, you could see resistance or people just not using the tech effectively, and then you lose all those efficiency gains.
So it's a people challenge just as much as a tech one.
Definitely. As for other risks, well, if those mid-sized firms do lag behind on adopting AI, then yeah, layoffs could certainly hit, maybe 10–20% of roles by 2030, particularly in operations-heavy areas. But that human factor, the trust, the empathy, the local knowledge that consistently came through as the key differentiator, that's what keeps you valuable.
Okay, so the individual loan officer role evolves, it doesn't vanish. Got it. But what about the company our listener works for, the mid-sized lender doing billions a year? Will they survive long term? Did the AIs confirm that fear we hear about the middle of the market just getting squeezed out?
Yeah, that's a really important point about the market dynamics. And yes, the AI models largely did confirm that. Mid-sized lenders, they represent maybe 20–30% of the market currently. They're definitely facing significant pressure. Many sources use that exact phrase, the middle of the market gets squeezed.
Why exactly?
Well, the thinking is the big lenders win on price and speed because of their scale and tech investment. Meanwhile, the small, really hyper-local shops, they often win on deep community ties, on that personal trust factor. So mid-sized firms that don't find a clear way to differentiate, they risk just getting lost in between those two extremes. However, it wasn't all doom and gloom. The AIs also laid out a best-case scenario,
Which is?
becoming an adaptive niche leader. This means a really rapid AI integration, often through smart partnerships, maybe with fintechs like Ocrolus for document processing or Angela for the origination side.
So leveraging outside tech.
Exactly, to boost efficiency. Then they focus on that personalized human-AI hybrid service, especially for more complex loans. And they differentiate by offering niche products, things like construction-to-perm loans, non-QM for unusual borrowers, first-time buyer programs, maybe green mortgages, investor loans.
Stuff the big guys might not bother with as much.
Precisely. Or offering personalized underwriting exceptions. Their agility, being smaller than the giants, could let them adopt tech faster than more bureaucratic competitors. And with those efficiency gains, growing to maybe $4 or $5 billion or even more in volume by 2030 seemed entirely possible in this scenario.
Okay, so that squeezed middle is a definite risk. But for those mid-sized firms that do adapt successfully, do the AIs give any surprising examples of how they might actually, outmaneuver the bigger guys or even the small local shops?
Yeah, interestingly, what came up was their potential for nimble specialization.
Nimble specialization, okay.
Think about it. Large lenders often struggle to tailor services or quickly launch niche products because they're just so big, maybe bogged down by older systems.
Right, turning the Titanic.
Exactly. And the smaller shops might have the local touch, but lack the tech sophistication for wider reach or complex processes. So mid-sized firms, if they quickly integrate AI for the back-end stuff, they free up their people. Their human capital can then become hyper-specialized experts in specific complex loan types or underserved markets. Ah, I see. This lets them offer a premium, really efficient service in that niche that neither the giants nor the small locals can easily match. They carve out a really profitable space. Now, the worst case scenario, of course, that paints a picture of becoming a consolidation casualty.
Getting bought up or going under.
Essentially, yes. That happens if AI adoption is too slow, maybe because of cost or just not having the resources. The big lenders then dominate with their fully automated platforms. They undercut on price. Lending becomes commoditized. These mid-sized firms would just struggle with margins, especially if loan volume is low and competition is fierce, leading potentially to shrinking, getting acquired, or even closing down. Plus, there's higher compliance risk if you're still relying on manual processes. Overall, the AI's projected maybe 20–30% market consolidation if things go this way.
Okay, so given these potential paths, some challenging, some quite opportunistic, what are the concrete, actionable steps? What should our listener and maybe their company's leadership be doing right now to aim for thriving, not just surviving?
The absolute key takeaway, echoed across all the AI sources, is this. You have to embrace tech and digitalization while doubling down on that irreplaceable human touch. It's both. So, first, for you personally as a loan officer, double down on your personal brand.
Yeah.
Borrowers might find you through some AI tool initially, sure, but they choose you because they trust you, because you're responsive, because you have a proven track record. That becomes even more critical. Second, leverage AI internally wherever you can, even if the mothership, the main company, isn't investing heavily yet. Individual branches can often adopt some tools for prequels, for marketing automation, for nurturing needs. Be proactive.
Find tools you can use now.
Exactly. Third, own a niche. Become the absolute go-to expert for something specific. First-time buyers, construction loans, jumbo financing, those complex self-employed cases, maybe particular geographic area. Be known for something. Fourth, push your lender. Encourage them to actively seek out tech partnerships. Partnering with vendors can help them compete on borrower experience and back-end efficiency without needing to build it all themselves.
Makes sense. Leverage others' expertise.
Right. Fifth, focus relentlessly on your data, especially your past client database. That list of people who already know and trust you becomes one of your absolute biggest competitive advantages when generating new leads gets even tougher in an AI world. Mine that gold. And finally, a couple more things. Regulatory savvy is crucial, proactive compliance is key, and strong liquidity management for the company. Weathering market shocks is essential. And for you